The investment strategy of Warren Buffett. Who hasn't heard of Warren Buffett? One of the world's wealthiest people, constantly ranking high on Forbes' list of billionaires? As of January 2023, his net worth was estimated to be $106.9 billion. Buffett is well known for being a successful businessman as well as a generous philanthropist. He is known as one of the world's most successful investors. This explains why Warren Buffett's investment method has reached mythical dimensions. Buffett adheres to several key ideas and an investment philosophy that is widely accepted around the world. So, what are the keys to his success? See the entire video to learn more about Buffett's method and how he's amassed such a fortune through his investments. Warren Buffett. A brief history. Warren Buffett was born in 1930 in Omaha. He was interested in the business sector and investing, especially the stock market, from a young age. Buffett began his schooling at the University of Pennsylvania's Wharton School before transferring to the University of Nebraska, where he earned an undergraduate degree in business administration. Buffett later attended Columbia Business School, where he got a master's degree in economics. Buffett began his work as an investment marketer in the early 1950s, but Buffett Associates was founded in 1956. He took over Berkshire Hathaway less than 10 years later, in 1965. Buffett revealed his intention to donate his whole fortune to charity in June 2006. Then, in 2010, Buffett and Bill Gates announced that they formed the Giving Pledge campaign to encourage other wealthy individuals to pursue philanthropy. Buffett's investment strategy. Buffett adheres to the Benjamin Graham value investing school of thought. Value investors seek securities with unjustifiably low prices relative to their intrinsic value. There is no universally acknowledged method for calculating intrinsic worth. However, it is most commonly determined by examining a company's fundamentals. The value investor, like bargain hunters, seeks equities that are undervalued by the market or stocks that are attractive but are not recognized by the majority of other buyers. Buffett takes the value investing strategy to a new level. Many value investors disagree with the efficient market hypothesis, EMH. According to this hypothesis, stocks always trade at their fair value, making it more difficult for investors to either buy undervalued equities or sell them at inflated prices. They believe that the market will eventually begin to reward those quality stocks that were previously undervalued. Warren Buffett has consistently emphasized the necessity of investing in oneself as a strategy of achieving success. This includes making wise financial decisions as well as expanding your knowledge of the fields in which you choose to participate. Buffett, on the other hand, is unconcerned with the complexities of the stock market's supply and demand. In truth, he is unconcerned by the activity of the stock market. This is the implication of his famous translation of a Benjamin Graham quote, "In the short run, the market is a voting machine, but in the long run, it is a weighing machine." He considers each company in its whole, so he selects stocks exclusively on their overall potential as a company. Buffett holds these stocks as a long-term investment, not for monetary gain, but for ownership in high-quality companies that can generate earnings. When Buffett invests in a firm, he is unconcerned about whether or not the market will eventually realize its value. He is concerned about the company's ability to generate profits. Buffett's strategy. When evaluating the relationship between a stock's level of excellence and its price, Warren Buffett asks himself some questions. Keep in mind, these are not the only things he analyzes, but rather a brief summary of what he looks for in his 6-step investment approach. 1. Business performance. Return on equity, ROE, is also known as stockholders' return on investment. It displays how much income shareholders earn on their shares. Buffett always looks at ROE to see if a company has consistently outperformed other companies in the same industry. The following formula is used to compute ROE. ROE equals net income / shareholders' equity. Looking at the ROE over the last year is insufficient. To examine historical performance, the investor should look at the ROE for the last 5 to 10 years. 2. Company debt. Buffett prefers a limited amount of debt so that earnings growth is driven by shareholders' equity rather than borrowed money. The D/E ratio is determined as follows. Debt to equity ratio equals total liabilities / shareholders' equity. This ratio indicates the proportion of equity and debt used to fund the company's assets The greater the ratio, the more debt is used to finance the company rather than equity. A high debt-to-equity ratio can lead to unpredictable profitability and high interest costs. For a more strict examination, investors may substitute long-term debt for total liabilities in the above computation. 3. Profit margins. Profitability of a corporation is determined not only by having a high profit margin, but also by constantly improving it. Divide net income by net sales to get this margin. Investors should look back at least 5 years for a decent idea of past profit margins. A high profit margin indicates that the company is running its operations efficiently, while increasing margins suggest that management has been exceptionally efficient and successful in controlling expenses. 4. Is the company public? Buffett usually only evaluates companies that have been in business for at least 10 years. As a result, most of the technological businesses that have gone public in the last decade would not be on Buffett's radar. He has stated that he does not comprehend the mechanics of many of today's technological companies and will only invest in a company that he completely understands. Identifying companies that have endured the test of time yet are now undervalued is required for value investing. In contrast to technical investing, which looks at a stock's price and volume, as well as how the price has moved historically, value investing concentrates on a company's financials. Never underestimate the importance of past performance. This displays the ability or inability of the company to increase shareholder value. However, keep in mind that past performance does not indicate future performance. The objective of the value investor is to predict how well the firm will perform in the future. This is inherently difficult to determine. Buffett, on the other hand, is clearly very excellent at it. One thing to keep in mind about public firms is that the Securities and Exchange Commission, SEC, mandates them to file financial statements on a regular basis. These documents can help you in analyzing critical corporate data, such as present and historical performance, in order to make sound investment decisions. 5. Commodity reliance. This inquiry may appear to be a bold approach to narrowing down a company at first. Buffett, on the other hand, considers this a critical question. He is wary of companies whose goods are indistinguishable from those of competitors, as well as those that rely primarily on a commodity such as oil and gas. Buffett sees little difference between a company and another in the same industry if it does not provide anything unique. Buffett refers to a company's economic moat or competitive advantage as any feature that is difficult to imitate. The larger the moat, the more difficult it is for a competition to obtain market share. 6. Is it cheap? This is the kicker. Finding companies that fit the other 5 criteria is easy. Evaluating if they are undervalued is the most difficult aspect of value investing, and that is Buffett's most valuable skill. To test this, an investor must calculate a company's intrinsic worth by examining a variety of business metrics such as earnings, revenues, and assets. And a firm's intrinsic value is frequently greater and more complicated than its liquidation value, which is what a company would be worth today if it were broken up and sold. Intangibles such as the value of a brand name, which is not immediately disclosed on the financial accounts, are not included in the liquidation value. Buffett compares the intrinsic value of the company as a whole to its existing market capitalization, its current total worth or price. Doesn't it sound simple? Buffett's success, on the other hand, is dependent on his unrivaled ability to precisely determine its underlying worth. While we may define some of his criteria, we have no way of knowing how he achieved such accurate mastery of value calculation. Buffett's top investments. According to regulatory filings from Buffett's public holding firm, Berkshire Hathaway, BRKA, it is possible to see which stocks Buffett has approved as solid investments, which include Bank of America, BAC, American Express, AXP, Chevron, CVX, Coca-Cola, KO, Kraft Heinz, KHC, Occidental Petroleum, OXY, Apple, Incorporated, AAPL, and U.S. Bank Corporation, USB. Buffett also owns a major investment in numerous privately owned enterprises, including Geico Insurance and the Burlington Northern Santa Fe BNSF Railroad. Is Warren Buffett a self-made billionaire? Yes, he did, however, come from a reasonably privileged home. His father did own a stock brokerage firm and later served in the United States Congress. This enabled Buffett to attend renowned universities such as Columbia. He did create his own business and made his own investments, which contributed to his great wealth. What is the best investment according to Warren Buffett? Warren Buffett has stated that the finest investment you can make is in yourself, in addition to identifying undervalued stocks based on fundamentals. There's nothing like focusing on your own skills, Buffett says. Self-development of interpersonal and communication skills, as well as gathering important knowledge, are particularly resistant to shifting economic conditions and cannot be inflated away. That's all, guys. Thank you for watching. Please leave your opinions in the comments section below. Like, share, and subscribe to our channel for more amazing videos.